On paper, America has a 40% death tax. 40%. When a fortune crosses from one generation to the next, the government is supposed to take nearly half of everything above a threshold. And yet, out of the 2.8 million Americans who died in a recent year, fewer than 2 in 1,000 estates paid a single dollar of it. The wealthiest families in the country pass down billions, decade after decade, and the toll booth sits almost empty, so either the rich are dying poor, or someone built a road around the booth. Tonight we drive that road, and it ends somewhere strange, a quiet office building in South Dakota. First, the booth itself. The federal estate tax in 2026 works like this. The first $15 million per person, $30 million for a married couple, passes completely free. Above that line, the rate is 40%. So meet the Hale family. Patriarch, founder, $50 million estate. Naively, that's $30 million exposed, $12 million owed to the government. But the Hales will pay almost none of it, and the first tool they'll use you've actually seen before on this channel. In our first episode, Buy, Borrow, Die, we ended on the word die and moved on. Here's what we skipped. Mr. Hale bought his company stock for $1 million. It's now worth $21 million. If he sold it alive, he'd owe capital gains tax on $20 million of profit. But he doesn't sell, he dies holding it. And the tax code does something remarkable. It resets the asset's official cost to its value on the day of death. His heir's starting price isn't $1 million, it's $21. The $20 million of gain doesn't get taxed later. It gets erased. It's called the step up in basis, and it's the reason the oldest rule in old money is simply never sell. So that's the income tax handled. But the estate tax, the 40%, is still waiting. For that, the Hales need Tool 2. The estate tax only counts what you own when you die, so the move is obvious. Own less, on paper, long before then. Every year, anyone can gift $19,000 per recipient, tax-free, no paperwork. That's the retail version. The wholesale version. Mr. Hale takes $15 million of assets, his full lifetime exemption, and moves them into an irrevocable trust for his children. Irrevocable means he can't take it back. It's legally not his anymore. And here's the elegant part. He gifted it at today's value. If that $15 million grows to $60 million over 20 years, all $45 million of growth happens outside his estate. The tax meter was frozen on the day of the gift. The booth never sees it. Now, if you're thinking, fine, but the kids will die someday too, and the booth catches the money then, Congress thought of that. Families used to skip a generation, leave it to the grandchildren, skip one funeral, skip one tax. So in 1986, Congress built a second wall, the generation skipping transfer tax, another flat 40%, specifically for wealth that jumps generations. 2 walls, 40% each. This is where the plan should die. But the second wall has a door, and one state propped it open forever. The GST tax comes with its own exemption, also $15 million in 2026. Allocate that exemption to a trust and everything inside it is shielded from the generation skipping tax. Not just the $15 million, all of its future growth too. Which raises the real question, how long can a trust last? Because for centuries, the law said trusts must die. An old English doctrine, the rule against perpetuities, forced every trust to eventually dissolve and pay out. And a forced payout is a taxable event. The booth always got its turn, eventually. Then in 1983, South Dakota quietly abolished the rule against perpetuities. The first state in the nation, a trust in South Dakota never has to end, never has to distribute, never has to face the booth. Combine the pieces, assets gifted in at frozen value, shielded by the GST exemption, growing inside a trust that lasts forever, in a state with no income tax on trust earnings. They call it a dynasty trust. One trust company in Sioux Falls reports over $165 billion under administration and more than 100 billionaire families as clients. The road around the toll booth ends in the Badlands. Now the catch, because there always is one. The two great tools mostly cancel each other out. The step up, the eraser, only works on assets you still own at death. Assets locked in that irrevocable trust generally don't get it. The old capital gains stay attached. So families must choose, escape the estate tax or escape the capital gains tax. rarely both on the same dollar. And all of this is jurisdiction dependent, politically contested, and rewritten more often than people think. The exemption itself nearly fell to half its size just last year before Congress intervened. Here's the transferable idea. These taxes aren't levied on wealth, they're levied on events, a sale, a transfer, a trust expiring. So the entire craft of dynastic wealth is controlling when events happen, or making sure they never do. That's the lens. And if you ever inherit an appreciated asset yourself, remember, its tax story restarts the day you receive it, knowing that one rule has saved ordinary families more money than most financial products ever will. A trust that never ends still needs someone to run it. Next time, the family office, the private institution built to manage a fortune like a business. This is the quiet ledger. Education, not financial advice. The ledger stays open,